Hey, what's up, everybody? Want to welcome you guys to my trading lab where I'm going to walk you through my thought process of how I search for stocks and how I build my trade. So let's get started. Step number one in any trading endeavor is finding opportunities, right? Because opportunities, if we are able to recognize patterns, we can find opportunities, and then we can define risk our trade to take advantage of these opportunities. So the first step is always looking at the S&P 500, which is the overall stock market index. Here you can see that we gapped up today and we're hitting all-time highs at 6,920. So this was called a couple of days ago when we saw that the index broke above the prior high, and we got followed through today, of course, with interest rates, the Fed cutting it by another 0.25%, and all the news going on with Asia, China, Japan. We have a big up move. And so we always say trade with the trend. The trend is your friend. So we are going to look for stocks that are uptrending. So now that I know what the overall market is bullish, I'm going to now go into my watch list and look at bullish trades. And for people that don't have a watch list yet, a good website to go to is actually, let me pull this up for people who are new to the channel. One of my favorite websites to go to is sectorspiders.com. And if you go here, the one area that I always like to go to first is the homepage. And this quickly gives me a quick snapshot of how the overall market did that day and what sectors did well. And you can easily say, the technology sector was up today. And if you click on the technology sector, you can see it makes up 36% of the S&P 500. So it's very heavily weighted, right? You can even trade these sectors. Just type in XLK. And if you want to look at some of the stocks within the sector, you can see NVIDIA hit $5 trillion in market cap today. And these are the biggest holdings, right? NVIDIA, Microsoft, Apple. So if you're just looking to build a watch list, you can just go in here and type in, this is the Thinkorswim platform, just type in Apple. All right, and the chart will pop up and we can see, are there any patterns that we can identify for potential trading opportunities, right? So let me just zoom in. Apple also at all-time highs as we broke through this resistance, right? This looks very similar to the S&P 500 because Apple, like you saw, the technology sector makes up 36% of this index. So whatever the index or whatever Apple does, most likely the index is also going to follow. And I'm just going to quickly go through and see if we have any opportunities. Amazon was one that we identified also a couple of days ago. Look at where it bounced off of support at 211, and we've already rallied all the way up to 230 in 2 days. So again, recognizing patterns allows you to make predictions, because when we're trading, we're in the market of making predictions. And if we can identify patterns, it's going to give us a higher probability of being right on our predictions. So that's step number one, finding opportunities. I don't see an opportunity setting up right now. GoDaddy did break this support. So if you're looking for shorting opportunities, GoDaddy is one that I was looking at. HIMS is one that we've been trading through this range. Look at this range where HIMS went up to 66, all the way back down to 40. That is a $26 range for a $46 stock, right? So this is a huge volatility. And if you zoom out a little bit, you can see HIMS has been going up very nicely. It's finding some sideways action but quite volatile sideways action. And as a trader, we can take advantage of this by saying, you know what, next time HIMS maybe trades down to like $45, maybe even 44, I can create a trade to enter. So this is step number one, is trying to find a trading opportunity. My searches feed my watch list. Let me really emphasize this with you guys. Understand that the process of trading is this. Your searches should feed your watch list, right? So you're searching for stocks, maybe looking at the S&P 500, maybe you hear something on TV, maybe Instagram post or social media, and you hear a stock, right? So those searches you put into your watch list. Then once you have a watch list, these watch list stocks help you narrow down what you're looking at. And then your stocks in your watch list then feed your trades. Because what I'm going to show you is when you see a stock in your watch list starting to set up, you want to then say, okay, create an alert, right? So here's how you easily do it on the Thinkorswim platform. Create alert. If this stock gets at or below, let's just say 44 bucks. I want to create an alert where it's going to ping me, and that's going to allow me to make sure that, oh, maybe I'm going to take a look at this a little closer because it's getting closer to a demand zone. Remember, support is nothing more than demand, because if we see that there was demand back here, well, when it gets back down here, we're going to look for an opportunity to jump on and ride it, hopefully back up. And this gives us a nice risk to reward ratio. So that's another thing that we're always looking for when we're trying to find a trade. We want to find trades that give us a good risk right here. And let me just quickly show you how I view my trades. I look at the potential reward based on the risk. So if I just create, let's say one of these boxes represents, I don't know, $100. Let's just make it easy, right? We're going to say, okay, well, if I get into this trade, I'm going to enter maybe around $45. My risk in this trade is going to be, let's say $100. So if it gets down in this area, I'm willing to buy the stock and put my stop loss right below, I don't know, here, let me just move this right below the support level, right? So my stop loss is always going to be below the demand zone, because if it does not bounce, I want to pull the plug to minimize my losses. As a professional trader, your number one job is to manage your risk, minimize your losses, cut them short, and then hopefully you let your profits run when the stock does bounce. This allows us as a trader to be wrong more often than we're right, and we can still make money. All right, so this is number one. We found a good trade here in HIMS and HERS. We all hear those commercials, right? Selling over the counter, drugs that are not FDA approved, but a lot of people are getting them through the mail. They're more discreet. So $20 range, I like it. Actually, $26 range. I'm going to risk in this trade about $5, and my reward is going to be 5, 10, 15, 20, $25. That is a nice 5-to-1 risk to reward ratio. So step number two, once I find the trade, the next step is building the trade, right? How am I going to manage my risk? So step one is, what are my trading rules? What patterns am I looking for to get into a trade? Once I find the trade, now you need to build the trade. And what do I mean by building the trade? I'm going to say, where is my exact entry price? So if I look and zoom in on this stock, I'm going to build the trade by saying, you know what? I'm going to get in if the stock gets down to my demand zone. We're going to call this $44. If this stock drops down to $44, this is my entry price, right? This is what a professional trader does. You know exactly where you're going to enter the stock. And let me just highlight it, save it for you guys so that you guys can see it. So if this stock tomorrow gets down to 44, I'm either going to set an order to get in or create an alert. Next, anytime you have your entry price, you always got to manage your risk. So where's my stop loss price? My stop loss is going to be if it goes down here, but then continues to drop. Let's say it's like a falling knife, right? Well, I'm going to get out at $39. This is my stop loss. So you are defining your risk. Remember, anytime you place a trade without a stop loss, you're gambling. If you place a trade with no stop loss and the stock continues to drop further and further, you're just holding and hoping that it comes back up. You are now gambling, right? Professional traders are professional risk takers. We take risk when the reward is worth it. And we look at our stops, right? When we exit the trade for a small loss, that's just a cost of doing business, right? But as long as we have 2 or 3 winners that run in our direction, boom, we can make up all the small losses and still be profitable. So entry, stop. My last is my target. So now I'm going to go in here and say my target price is going to be about $60. Is this realistic? Number one, yes. Why? Because to the left in the past price, we saw that it hit 66 in May, again in June, again in August, again in October. So why? I think my prediction is if this pattern continues, then we can easily get back up to 60. So what is my risk in this trade? I'm risking $5 to make $45, $15. So that is a 3-to-1 risk to reward ratio. All right. So now that I've built the trade, now the last step is to execute the trade. And when I say execute the trade, how am I going to place my orders so that if the stock does get down here, I don't have to be at the computer screen to enter the trade? I like to automate the trade. The reason why you want to automate the trade is because you want to remove all emotion. You don't want to be stuck at your screen. You want to go play golf, go have lunch with your buddy. And then if the stock gets down and meets you at your specific price level, that's when you enter. So let me show you quickly how to do that. You right click, choose buy, and then you're going to change, or you're going to use a limit order. People who are not familiar with trading, a limit order just means there's 2 main orders. A market order means just buy it right away. I don't care what price it's at, I just want in. A limit order specifies this is the maximum I'm willing to pay, which means I'm only willing to buy this stock at a limit price of $44. And that means only buy it if this stock drops down to 44 bucks, or the stock drops down to 44 bucks. So here you can see, right? I have an order waiting to buy 10 shares if this goes down to 44. See how easy it is? It's almost like playing a game of fishing, right? You're just waiting for the fish to bite your order. And if it bites, boom, you're in the trade. But what's even better is when you're executing the trade, you want to put in your stop loss right away. So let me show you how to do that. So you could just go in and edit this order. And this is a more advanced order type. So it's called the first triggers, one cancels other. Basically what this is saying is if the buy order is triggered, I'm going to put in a one cancels other bracket order that puts in my stop loss and my profit target. So here is what you do. The first order is to buy 10 shares at 44 bucks, right? Then I can just right click and create an opposite order. This is going to be my second order, which is selling 10 shares. But I'm going to change this from a limit order to the third most popular order, which is the stop order. A stop just says if this stock hits my stop price of $39, I want to sell, get out of my position. And that way I am only risking $5 times 10 shares is $50, right? So this is my stop loss. But what's even better is I could put in my profit target. So I'm just gonna right click, let's say create a duplicate order, but instead of a stop loss, now I'm gonna put a limit. So when you wanna sell a stock for a profit, you're putting a limit order. A limit just means sell it at this price or better, meaning it's not gonna sell or trigger until the stock actually goes up to $60. And this is a good till cancel order. And now I can actually place this trade, and check this out. I don't have to be at the screen anymore. Here, let me just delete all this so that it's a little cleaner. Look at this trade. I am in this trade and it's all preset. It is automated. This is called executing the trade. What am I doing? I'm waiting for the stock to drop down to this potential demand zone. If it gets down here, I'm going to buy it automatically, 10 shares at 44 bucks. And if it triggers, it's automatically going to put in my stop loss order and my profit target order. This allows me to define my risk of $5. Here, let's change this to, actually, let me just create my other risk to reward. This is a quick way to kind of visualize what your risk to reward is in the trade, right? So this is about a 1, 2, 3, almost a 4-to-1 risk to reward ratio here. So this is going to be red. And look, I'm risking $5 here to make 1, 2, 3, 15. And my target here is actually at 60. So if I enter at 44, 60 minus 44 is actually $16, right? Actually, let me make sure I got my calculator right. So if I sell at 60 and I get in at 44, my profit target is 16. So I'm risking 5 to make 16. That is a nice 3-to-1, a little bit over 3-to-1 risk to reward ratio. This is what we mean by building the trade. And then you just sit back and wait. The rest is just money management, making sure that you're just risking, a small portion of your account, and you're waiting for these patterns to potentially bounce and hit your prediction. So that is how you build the trade. This is how you trade like a pro. Let's review. Number 1, you want to find the trade, right? How do we find the trade? We go through our watch list. Here was a great example. Look at ISRG. This is a stock that we identified right here on October 6th. We saw that it was bouncing off of this prior bounce. It consolidated right here at $430, and then boom, look at that. Look at this big, huge, and it went back up to the prior high. That is almost $120 move in 2 days. That is how you make money in the markets, and how you put the probabilities on your side by looking at patterns to help you predict what's going to happen in the future. So hopefully you guys got a lot from this quick video. If you guys like what you see, just leave a comment, subscribe, and what I'm going to do is, if I get enough people, I'm going to create my first class where I teach you step by step how to find a trade, how to build a trade using money management, and then how to execute the trade, mastering the tools of your trading platform so that you could just set it and forget it. And before I take off, let me just show you how you can actually create a trade using options, right? So I'm just going to quickly introduce you guys to options, because what the advantages of an option versus a stock. ISRG, Intuitive Surgical, trading at $537, right? So if I wanted to just buy 10 shares of this stock, it would cost me, 10 shares would cost me $5,494. You know what? Instead of me tying that much capital, why don't I go into the options market? And here, let me put in ISRG. And here, this is my other trading platform, Tastyworks, which I also used to work on the Thinkorswim platform when Thinkorswim, before I got bought out by Charles Schwab. But here, ISRG, instead of buying 537, if I thought that this stock was gonna just say stay below 560, I could go into the options market. Remember, options are nothing more than bets on stock. So I can go in and say, you know what, I'm looking at a bet that is it's got about 51 days left to expiration. Look at this. This tells you how much these bets are going for, and I can create trades. I can build strategies that will define my risk and cost me a lot less. So for example, if I thought that the stock was gonna go, I don't know, let's just hypothetically say, I think the stock is actually going to go back down. Let's just say we think it's going to hit resistance and we think it's going to go back down to, I don't know, 450, right? You can actually go create a trade and say, okay, well, in the next, say 23 days, in the next 23 days, I think it's going to go down to 450. I can go here, buy 295. Actually, we go even lower here. Let's go buy 260. Let me delete this leg, right? It's only trading for 380. Right now, the markets are closed, so the bid-ask spreads are a little bit tight. I could go in and sell another spread, and this trade is only going to cost me $155. What's cool is my buying power effect, it only costs me $1.55 per share. Options, of course, hold 100 shares in one contract. Therefore, this trade only cost me $155. The most I can make in this trade is $845. If this stock were to drop all the way down to 450 right here, down here, in the next 23 days, I'm making $845. And the math is really easy. If you guys don't know about options, I definitely recommend you guys watch my option videos. And I'm also going to create a course that easily explains options because they're not that complicated. They're nothing more than bets on the stock market. All right. So you can just click and confirm this order, send it through, and we'll wait to see if it gets triggered. So that is a quick update. Before I leave, a lot of people ask me, Nick, why should I trade options? I thought options are risky. And the truth is, options are risky if you don't know what you're doing. If you don't know how options are priced, what options actually stand for, which basically is a bet on a stock. Let me briefly teach you guys or show you a video that I'm creating for my future options course that actually allows you to, here, it'll teach you what the advantages and disadvantages of trading options versus stocks. So let me share my screen here. And this is what I'm going to be working on. It's not quite live yet, but I do want to get you guys aware because I'm planning to launch this thing in the next maybe 2 to 3 weeks. So if you guys want to get on the list, put a comment below and I will put you on the waiting list and I'll give you a 50% discount for the first 10 subscribers. All right. So this is what you do. You're going to log in. I've been creating this for maybe, over the last few years, I've been working on this. So you're going to see a library, and this is going to be my Master Trader Academy. And in this, you become a member, you're going to get access to all my coaching, right? These are my weekly coaching sessions. You're going to get my course video library into the stock market, how to trade, 3 parts to a trade, how to short stocks, how to manage your money, how to use your trading platform, and then finally how to create a complete trading system to manage your own portfolio with stocks. But this is only the beginning. The ultimate goal is to trade options because there are a plethora of reasons why options give you an advantage over stocks. So let me just quickly preview this video with you guys. And you'll see a hint of what's to come. So check this out.
Lesson 1. Intro to Options. In the following videos, I'll show you how to take your trading to the next level by showing you how to trade options like an expert. Trading options increases your probabilities because you can make money when a stock goes up, goes down, and even sideways. As an options trader, your goal is to create a consistent return on your account month after month. This may sound overly ambitious at first, but with the proper options education and training, you'll understand that the key to making consistent profits each month is not buying options, which most traders do, but selling options. So are you ready to learn how to trade options like an expert? To start, here's a brief breakdown of what you'll be learning in this course. You'll learn why options are better than stocks, the power of leverage, options terminology, options pricing, the importance of volatility, why selling is greater than buying options, how to choose the right option to sell, and how to develop a high probability options trading system. But before we begin, let's take a look at some of the main differences between a stock and an option. Stocks are actively traded on the New York Stock Exchange, but options are traded on the Chicago Board of Options Exchange. When you buy a stock, you own one share of the company. When you buy an option, you're actually buying a contract that controls 100 shares of stock.
All right. So briefly, when you buy a stock, you buy a stock for the price of the stock. When you are trading options, you are no longer buying shares. You're actually making a bet. You have a contract, which is just a betting slip that says, I think the stock is going to get to this price by this amount of time. The main difference between stocks and options is that options expire, meaning after a certain amount of days, the bet either wins or it loses. Stock, you can buy and hold forever.
With stocks, you pay the full price for the share. With options, you can control the same stock for a fraction of the cost.
So an option is a derivative of stock. So why pay the full price when you could actually take a position, let's say a bullish position, but you only have to pay maybe instead of $100 a share, you might only have to pay $5 a share. Right. And because an option controls 100 shares, these bets or these what an option premium is worth basically is just where does the market think the stock is going to go, which we'll explain later.
With stocks, you can buy and hold for as long as you want. With options, your contract has an expiration date. And last, stock prices move one for one, meaning if the price goes up $1, you make $1. Options, on the other hand, are a derivative of stock, just with more leverage. So if the same stock goes up $1, you can make $3. But we'll get more into this later. Now, why is trading options better than trading stocks? The first reason is because it costs a lot less to trade options versus trading stocks.
Right. So this is what attracts most people to the options market. They get in because it's a lot cheaper. Honestly, to buy stock, you need at least like $20,000, $30,000, right? To buy a significant amount of shares that actually makes a difference in your portfolio. But you can participate in the exact same movement of the stock by buying an option on the stock, and it costs you a lot less. Like you said, you saw earlier, I could create a trade that's $100. I could put a $200 bet, and I can make maybe $400, $500 from that bet if the stock does what you think it's going to do. So number one, most people are attracted because it costs a lot less money. You could start trading options with as little as $1,000 to $2,000 and still get in the game.
Many people choose not to trade because they have limited funds. But with options, you can get started with as little as $1,000 to $2,000 in your account. For example, if Starbucks is trading at $50, To buy 100 shares of stock, it would cost you $5,000. But with options, it might only cost you $1.20 a share to control 100 shares of Starbucks, costing you $120.
All right, you know what? Let me show you a real life example of this. So watch, let's pull up Starbucks. So if I wanted to trade Starbucks, right now it's currently trading at $84, right? And this was a stock that we also looked at the other day where we saw it bouncing off of support. Remember, if you could identify patterns, you use patterns to predict, and we predicted that the stock was going to bounce, and it did, right? We put in $2 of risk to make $6, and we're almost already there. So watch, if I wanted to buy 10 shares, say 100 shares, right? I'm going to go buy, and let's change this to 100 shares. How much would it cost me, right? 100 shares at $90 per share is $9,000. Well, dude, $9,000 to put a position on just to buy 100 shares of Starbucks. What if I told you I could actually trade an option? And remember, an option controls 100 shares of stock, okay? Don't worry if you don't understand it now, but this option, look at this. It's only going for $4 a share. See these prices right here for these different option contracts that have different strike prices? This is how much you're paying per share. But because an option controls 100 shares, watch. If I were to buy it, right? Buy here, let's make this one contract. If I were to buy one contract at $4.05 per share, if I click confirm and send, right, the trade would cost me only $405. That is so much less than $9,000. And what this trade is saying is it's going to control 100 shares of Starbucks, and I'm paying $4.05 per share, or the whole contract is $405. This tells you this. If you don't understand it, don't worry. The stock, or actually the strike price that we're buying here is what? $84. I'm paying $4 for the right to buy Starbucks at $84. What that means is if I were to hold this, it's predicting that the Starbucks is going to go up to $88. $84 strike plus the $4 premium that I bought. You add it, that's $88. So your break even is saying that the stock needs to go up to at least $88 for you to make money by expiration. That is why it's a bet. But that's why it's so cheap, right? You're only paying $4 a share for this bet because it's going to expire in how many days? 23 days. So this stock within the next 23 days needs to go all the way up to $88. Anything above that is pure profit, right? So if you really are right on direction, there's a lot more bang for your buck trading options if you know what you're doing. Remember, most people lose because they jump straight into options and they don't even know how to read a stock chart. That's why at Trade Like Nick, there's a very simple blueprint process. Number one, learn how to read a stock chart. That's basic technical analysis 101. How do you identify demand and supply zones? How do you identify a trend? Once you know how to read a price chart, a stock price chart, then you go into options and then you figure out how can I build option trades that will match the same outlook that I have for stocks, right? This is where you become a more intelligent, educated investor, where not only do you have strategies for bullish trades, but you also are equipped with strategies for bearish trades and even strategies for stocks that go sideways. You could buy options, but my philosophy is sell options. And you'll learn that also in my advanced options course, where the probabilities are on your side, right? You can build the option trade and then you learn how to run it like a business. That is the advantages why options are greater than stock. Again, you saw how a $9,000 trade, I created a trade down here that's only going to cost me $405. That controls the same amount of shares. All right. So let's go back to the other advantages of options.
As you can see, options is a lot less capital intensive than buying stocks. The second reason traders prefer options is because it allows them to make money in different ways. With stocks, you can only make money when the stock goes up or down. With options, you can make money when the stock goes up, down, and even sideways. The third reason traders prefer options over stock is because of leverage, meaning you're able to control the same amount of stock at a fraction of the cost, which can significantly increase your return. Let's go into what leverage is a little more. Leverage is the ability to magnify your returns by controlling a large asset for a fraction of the cost. For example, when you purchase a home, you are controlling a large asset, the home, for a fraction of the cost, or your down payment. Therefore, when the value of your home increases, the rate of return on your investment goes up even more. Let me show you why. Suppose you put a $20,000 down payment on a $100,000 house. Say the house goes up 20% or $20,000 the following year and you sold it. What percent return did you make on the sale? Most people make the mistake of saying 20%, since they divide their profit of $20,000 divided by $100,000, or the original price of the house. But this is incorrect. Since you only put down 20%, or $20,000, and borrowed
So
the rest from the bank,
a lot of people,
your original investment is
of
only
people say,
$20,000.
well, they think they only make 20% if the house goes up $20,000, right? Because they base it off the $100,000 of the house. But if you only put 20,000 down, you actually made 20,000 off of your own $20,000 that you put down. You actually made 100% on your investment because you didn't put down the full 100,000. You only put down a fraction of it, but you still got to participate in the appreciation of the entire value of the house. And that is what options is as well. Instead of buying all 9,000 shares of Starbucks stock, you could actually put a down payment on it. And if Apple or what Starbucks goes up, your contract, your option contract that you only paid a fraction of the cost also increases in value in relation to the actual stock.
And not 100,000. Therefore,
hold on here. So that is basically
equals 100%. As you can see, using leverage magnifies your returns by allowing you to control a large asset for a fraction of the cost. You can use this power of leverage when trading options, but you'll learn more about this in more detail in the videos to come. So to recap, you learned the difference between options versus stock, you learned all the advantages of trading options over stocks, and you also learned the power of leverage. In the next few videos, you'll learn what an option is, how an option is priced, and how to trade options for consistent profits.
All right, so that is a brief overview of what you'll see in the upcoming weeks that I'm excited to release over the stocks course as well as the options course. All right, everybody. So hopefully you guys gleaned a little new information, how easy it is to trade like a pro, how to find your trades, how to build your trades, and finally, how to execute and automate your trades so that you don't have to be there, but you could just let the order wait and for you to trigger in. And that's exactly what we did in our example here in HIMS, HIMS, waiting for it to come down and then see if it bounces right back up. All right, everybody. Hope you guys learned something new. Remember, like and subscribe. I would really appreciate it. It would help me really build out this course the way I want it, design it the way I wish I had it when I was a student, struggling to learn all this, only to realize that it was a lot easier than what people make it out to be, and that the hardest part is actually our psychology, our mindset. The actual mechanics of trading, the money management is very easy, right? It's actually mastering yourself that is the difficult part. That's why trading is simple, but not easy. And that's why you always need to trade with discipline, with integrity, and with a plan.